What's going on? Welcome to the Smart Helping live stream. We're going to be doing accounting ratios today. Fun stuff. But first, we have a couple things to get through. And note, I feel like crap right now. I had this cookie for lunch. It was bad. I'm never going back. So I'm drinking some black tea right now, trying to feel a little bit better. But we'll get through it here. So, first I want to start off with our model giveaway. At the beginning of every stream, Monday at 5 p.m. Eastern Time, I do a random giveaway. You can pick any template on smarthelping.com. And if you win, you get to pick one and I'll send it to you. You get on this list if you've already bought a template. Without further ado, I just use a rand between function and based on everybody that's on the list. So 1147 is the winner. We'll save that. I'll send you an email after the stream. Congratulations, 1147. Also, don't forget to like the stream, subscribe, join the stream, $4.99 a month if you want. I'm very grateful. We have 3 stream members right now. 2 of them have resubbed for a second month, Jeffrey and Kareem. Also, thanks to Troy. You guys are the 3 members that are currently subbed to the live stream. It's a great support. It keeps me kind of going on this, and hopefully we'll grow. So before I get into this, let me do a sound check real quick.
Hey, I'm good.
Let me see here. Test. Test. Okay.
Test.
Okay, we're good. Perfect. Looks good. So accounting ratios. We're going to get into a whole bunch here. And I'm just going to start Googling. We're going to build all these from scratch. And most of the information is going to be attained from financial statements. Some could be from supporting documents or other things, market cap. But the goal here is produce as many ratios as I can in 2 hours. So ratios. And I might do a little explainer next to each one, like how it's used. So let's just start it, ratio 1. Most used financial ratios. Six basic financial ratios and what they reveal. Working capital. Perfect. Now I'm assuming that's something with liabilities and or debt. Let's see. Working capital represents a company's ability to pay its current liability with its current assets. So that means, what are your accounts receivable? What's your cash? Current assets would be like cash, accounts receivable, inventory, and then it'll measure that against what your current liabilities are, which would be short-term debt, bills, payables. Essentially, it's trying to do payables, your payables versus your receivables, but there could be some other things in there. So it's an important one. Working capital ratio. Oh, there it is, the ratio. Working capital. Yeah, within a year. So current assets are assets that are 1 year or shorter. We'll just put in, let's see, how do I want to structure this? You know what? I think it's actually best to do a tab for every one of them. I think that's the best. So working capital. Let's look at it. So you're going to obviously pull this off the balance sheet. So balance sheet is one of the financial statements. Of the main three, there's cash flow statement and income statement. So working capital represents the difference between a firm's current assets and current liabilities. The change can be determining the challenge can be determining the proper category for the vast array of assets and liabilities on a corporate balance sheet and to serve an overall health of a firm and meeting short-term commitments. Right. An accounting classification is insane. Based on different justifications, it could get pretty nuts. Assessing the wealth of a company in which you want to invest involves understanding its liquidity, how easily that company can turn assets into cash. Well, essentially, if a company doesn't have enough current assets to pay its current liabilities at a snapshot in time, because that's what a balance sheet is a snapshot in time, then they're in trouble. Obviously, they need to make some sales and increase their receivables. They might need to work on their cash conversion cycle. They might need to be tracking their liabilities or their payables and receivables better in general. Like maybe adjust the terms that they're paying their suppliers, or what their receivable terms are from people that are buying stuff from them. So we'll do a couple things. One, so current assets is going to be a culmination of a bunch of things. That's going to be some number here. We're going to sum up everything above it. And then current liabilities is going to be another number. And then we'll put the ratio right up here in bold. And it's just going to be assets divided by current assets divided by current liabilities. So if it's a positive, if it's above 1, then let's say the current assets are 155, liabilities are 122. And usually on financial statements, everything's abbreviated, so you see 1, 2, or 3 digits maximum. And they'll be the millions or thousands or billions, whatever. So here 2.5 is saying you've got enough current assets to pay all your current liabilities 2.5 to 1. Now I think it's sometimes easier to look at this stuff from the perspective of your own household finances. So what are our current assets of a house? Basically your checking account and technically your paycheck. So the amount of money you got coming in a given month, or that's due to you, and the amount of money you've got to pay every month. So debt, car payments, it's not expenses. So don't think it's expenses. It's not like, and oftentimes, like in a company, expenses will be recognized when the payable is actually paid. But what we're trying to figure out here is if you look at all the money you owe and all the money that's owed to you, where do you sit? And typically, if you live paycheck to paycheck, your assets are your current assets are going to equal somewhere close to your current liabilities. And if you can get that higher, get your cash and the amount of money your job owes you every 2 weeks higher than the value of your debts. And I guess you could think of it in the context of a full year, like how much you make in a full year, how much you owe in a given year. I don't know. I guess it's not really, I don't know, I'm thinking about it, it's not really applicable to a household. when you drive down to it like that, but let's zoom back out to like a company level. Okay, so let's now get some current assets in here so you know what the heck I'm talking about. Right, so current assets. You've got, so yeah, cash, cash equivalents, receivables due less than a year, and then inventory. I guess an investments could be because you can, assuming they're liquid. Hold on, let me look. Let me get a couple of sources here. Okay. Things that are not current assets would be like your building, equipment, things that you're holding for a long time that you probably still owe money on. Intangible assets. Okay, so we're gonna just gonna do some common things here. So total current assets we have balance sheet period ending and then X. Let's get rid of our grid lines. Cash in bank is definitely a current asset. Short-term receivables. So this, you can't include a long-term receivable. For example, let's say you did a loan to something that's like a 30-year amortization that they're paying you. That's not a current asset. What am I doing here? We want the dotted line. Short-term receivables, inventory. That's going to be it for like 95% of people. So make these cells editable. It's always important with any model, even if it's not, technical. This is not like a startup financial model, but this is still a model where you got inputs and outputs, and you want to make it clear what's editable for someone trying to use this. So cells in this shade are editable. What's your, okay, so cash in the bank, some number. All these are currencies. Short-term receivables, inventory. The reason why inventory is on here is because usually you'll sell your inventory off within a year. So that's considered a current asset. And maybe you have other current assets. Just like a catch-all. Right, let's sum that up. So current assets, 62,000. Now I also want to look at, all right, let's put some current liabilities. We're going to look at some reasons why the internet says it's important, and I'll see if I agree. We did 4 there, we'll do 4 here. Remember, this is not the full balance sheet. We're just putting in the items related to the working capital ratio up top here. . this is equals current assets divided by current liabilities. So what's the current liability? Short-term payables. So these are like vendor payments you gotta pay every month or two. What else? Let's think. Short-term loans. Not a mortgage, but like a short-term loan. It could be a 3-month construction loan, something like that. Short-term loan. And this is the balance. This is not looking at your interest and principal payments. This is looking at the balance of everything. So it's like if you had to go bankrupt today, sell all your assets, pay all your liabilities, how much you have. Or all your current assets and all your current liabilities. Not all assets and all liabilities, because that's a different number. But this is for just working capital. And working capital is considered to be things that are 1 year or less in their term. Accounts payable. Short-term loans payable, accounts payable. This is accounts payable. I guess we could put here, instead of short-term, this could be just accounts receivable. Just expect that those are 1 year or less. Accounts receivable, accounts payable, short-term loans. What else is a good one? Accrual stuff we're not going to put in here. Deferred revenue. Accrued, yeah, accrued. Everything else is basically accrued expenses. So that means, so I guess you could put, so we'll do a catch-all, accrued expenses. So these are expenses like rent. Let's say you, well, no. Better term. What's a good one? Accrued compensation and benefits. I guess it means you've recognized the expense, meaning it's gone out of cash, or it's not gone out of cash. It's been recognized, the services have been performed that you paid for, but you pay for it on account. So this is cash. These accrued expenses are cash items that have not yet been paid, but they have been recognized. And it's kind of like a debt. So accounts payable, short-term loans. Accrued expenses. Other current liabilities. Now this, you can definitely think of this like your personal budgeting or personal household finances is your let's say you owe some friends and family money and you have some cash in the bank, and if you had to settle up right now, you know, how much money do you have in assets, current assets, that you can sell off to pay what you owe right now? Let's say your payables are less. So there is a ratio of 0.6. Wait, no, not 100,000. So this is greater than 1. It means you've got more current assets and current liabilities. Well, this has been a long ratio. If these all take this long, we'll only get about 5 in. Important Let's see what the internet says about importance of working capital ratio. Working capital ratio is important to creditors because it shows the liquidity of the company. Okay, so liquidity. So it's basically saying anything that can be turned into cash within a year is liquid. Anything that can't is not liquid. Current liabilities are best paid with current assets like cash equivalents, market securities, because these assets can be converted into cash much quicker than fixed assets. Yes, like selling a building could take years. Selling your inventory in cash is like available much quicker. Serves as a metric for how efficient a company is operating and how financially stable it is in the short term. Working capital ratio, which divides current assets by current liabilities, indicates whether a company has adequate cash flow to cover short-term debts and expenses. So if you're the CFO, you definitely need to know this. Helps maintain smooth operations. All right, let's move on because that's good for that ratio. I'm going to copy this so I don't have to redo the formatting. We have working capital. We're going to do the quick ratio. Some of these things will involve the same items on the financial statements. Some might not. This is like, quick ratio, asset test. Heard this a lot before. Subtracts inventory from current assets before dividing that figure into liabilities. The idea is to show how well current liabilities are covered by cash and items. We're getting this from Investopedia, by the way. Dividing that current into liabilities. So a quick ratio does not look at inventory. Now this is tricky. So the quick ratio is taking inventory out of the calculation and then doing the same above, like current assets divided by liabilities. So do not include inventory. So we're gonna like black this out. Not included in the quick ratio. Current assets less inventory divided by current liabilities. Now, if you have a high inventory turnover, you may have a ratio below 1. Or if you just have very bad operational cash flows, that could also mean why it's below 1. But if you have a high inventory turnover, like you keep selling it, and that's not being calculated in your amount of assets you had to pay your liabilities, even though it's, for example, if you turn over your inventory every other week, it could be that none of that's being counted in the ratio, even though it's a huge part of everything. And it's just looking at the amount of cash you have saved up, which if you're a growing company, you might not have much because you're investing it. It's still looking at receivables, and then essentially anything else you can turn into cash within a year. So that is fine. So here we don't include, so minus this. So same ratio as working capital, but we're not including inventory. Oh shoot. I updated the wrong one. Hold on. Dang it. This is the quick ratio. This is working capital. Man, we are slow today. It's 5:30. Is my thing on public? I don't see anybody in the. I saw one viewer and that was it early. I guess accounting ratios could be boring. Still good though. If you have a business that you're running, this stuff's going to be important to look at. And especially if you're trying to get money from a bank or something, they're going to look at all this. Sourced. I'm going to put changes to sourced from balance sheet. Okay, next, earnings per share. So earnings per share is net income divided by the shares. Pretty simple, earnings per share. Now, depending on their accounting practices, it could be negative or the company's state, but this is a pretty easy one. We're not going to get too in depth on how to calculate net income. The company has divided its net income by the weighted average number of common shares outstanding during the year. Okay, so it could be if you're looking at a full year period instead of a snapshot in time, you do a weighted average, or if you're trying to get, because the shares could change. Like if you look at the annual net income, and then maybe they had X shares in January, and by March they had less than that or more, they issued more, bought, did something, it could change. So EPS. Earnings per share. So this is net income for period divided by weighted average outstanding shares in the same period. So pretty easy one to calculate. You're going to use the income statement for this, and then wherever outstanding share data exists. Can't spell. Outstanding. So here we just have, don't need any of this. Net income, let's say it's randomly $50,000 for the period. And then the other number we need is weighted average outstanding outstanding shares. And that's a number. Let's say it was 1 million. So this divided by this. Earnings per share here, 5 cents. Now if you only had, let's say, 10 shares, your earnings per share is $5,000. And it's arbitrary, it's depending on how many shares there are. Let's put 1 million. So very easy one there. From the income statement, and again, you'd have to find source data for outstanding shares for the period you're measuring. Next up, price to earnings. Hold on, I'm checking. It is a slow Monday. Today's been slow in general, which happens sometimes. People could be busy doing a bunch of stuff or whatever. We're getting into fall. Just want to make sure this is public and everything. Yeah, I mean, it's there. Okay, price to earnings ratio. And again, I feel like I went over why working capital is important, why in a quick ratio is the same thing but without inventory. Earnings per share, it's just kind of self-explanatory. It's just based on the shares that exist, what's the earnings for every individual share. Price to earnings ratio. Now that's going to be something to do with the market cap. PE for short. This ratio reflects investors' assessments of those future earnings. You determine the share price of the company's stock and divide it by the earnings per share. Okay, so this is linked to earnings per share, but it's based on the share price. So price to earnings is kind of a multiple. All right, let's make a copy of this one. This is kind of saying, well, here's what the shares are making in net income, but if they're trading at, so let's say in this situation, each share is worth 5 cents in earnings. Because remember, when you buy stock, you're buying a part of the company, which is essentially how much you're buying a share of the profits that, or what it produces. Now, the price of a stock, if it's public, is going to be probably higher than earnings per share. For example, Amazon had like a negative for so long, but their price traded up very high because the future value of what people think it'll be worth could be much higher than what they're currently doing. So the earnings per share says, okay, here's what they're doing right now. The share price that's publicly traded is trying to price in a whole bunch of different factors. If you believe in efficient market theory, then it's essentially every existing factor or factor in existence and what people think about the future of the company, what it might become. So this is kind of showing the multiple between what it actually is and what it's being valued at. So price, hence price to earnings ratio. Simply usually referred to as a PE. Now this we do, so we can look at, this will be a ratio or a number, not a value. We'll look at the earnings per share first. Again, it's here. And then we want market price per share. Let's say it's trading for $40.50. So $40.50 divided by its it's a high multiple, 810. Let's say it's at $5. That's 100 multiple. Let's say it's trading at 2.3. So usually, the way analysts will look at this is they'll say, hold on. They'll say, well, the company's making this, but we think it's going to be making X, Y, and Z in the future. So we will trade it at a multiple of some number. And if you look at what the actual share is, if the actual market share price is less than your target based on what you think the multiple should be, you think like if it's traded at here 46 times earnings, and you think it should be traded at 100 times earnings, then technically you should buy that because you think it's worth double the share price. 1, 2, 3, 4. This is a ratio of 4. And so that's a pretty where's this sourced from? So we know where the earnings per share is sourced from, which is this. So we're going to get income statement information to figure out that, and then market price is just public. And the price is just whatever the price is at the time you're doing the analysis. Alrighty, so next ratio we'll do debt to equity. This one is, so what if your prospective investment target is borrowing too much? This can reduce the safety margins behind what it owes, jack up its fixed charges, reduce earnings available for dividends for folks like you, and even cause a financial crisis. So debt to equity, actually that's when you see a lot in personal finance too, but it's calculated by doing outstanding long and short-term debt divided by the book value of shareholders' equity. So this is going to be, we're getting a little bit more into the financial statements on this one. Let me get back to here. We'll copy the working capital tab. So now we're getting into some more complexity. So debt equity ratio. And it's just called debt equity ratio number 1, 2, 3, 4, 5. So we're probably going to be pulling mainly from the balance sheet, but let's look here. So whatever. So we're adding outstanding long and short-term debt. So all liability, well, yeah, all liabilities. I guess that's how you define debt, though. Outstanding long and short-term debt. Let's say XYZ has about $3 million worth of loans. Okay, so it's not like all like accounts payable, it's just obviously debt to equity. I guess if you think of it at a high level, it's just the loans divided by the book value of shareholders' equity. Okay. That's not actually that complicated. So if you have $3 million for loans and shareholders' equity is $13 million, ratio of 0.2. So I'm assuming a debt to equity ratio is good. No, I'm not assuming it is good if you have less debt than equity, so below 1 is good. So 0.2 is acceptable and under most circumstances. However, like all ratios, a metric has to be analyzed in terms of industry norms. And yeah, right. Every company is going to be different. Depends on what sector and all that. So this is definitely a balance sheet. We're going to do. We don't care about assets in this case. We care about. And let's. Do we want to do? Yeah, I think we can. So let's do shareholders' equity. And we only want the book value of that. So what items go into book value shareholders' equity is what we need to figure out. And then current liabilities, we don't want. We want debt. Now this is easy. This is just short-term loans, long-term loans. That's a simple one. And I guess we could put. I mean, it's short. It's either short or long-term loan. There's nothing else for debt. And then the ratio is going to be debt divided by this, so book value of shareholders' equity. So let's look up book value of shareholders' equity. Book value of equity, also known as shareholders' equity, is a firm's common equity that represents the amount available for distribution to shareholders. The book value of equity is equal to total assets minus total liabilities, preferred stock, and intangible assets. Okay. So we actually want to do a full balance sheet here, and I want to highlight what items to look at. So the book value is your total assets minus total liabilities minus preferred stocks. That's why I'm saying common stock or common equity. And it's not has anything with intangible assets. And the reason why intangible assets aren't included here is because it's not counting that as something to be measured against the amount of debt you have, because probably my guess is when they determine how this ratio is going to work, you never know what an intangible asset might be able to be sold for or valued at. So I'm assuming that's probably why we're subtracting that out. Okay, so we're gonna do a full balance sheet here. Not super complex, but let's just so assets, liabilities, and owner's equity, or assets. Okay, let's go over here. And the reason why I want to do I could just say, okay, enter in book value of equity, enter in total liabilities, and 0-0 ratio. But I want to show how it fits in this case. I think it's important to show how it fits into the whole balance sheet. So let's say you've got some current assets here. We also want to show what's excluded. I think that's important. So company's market value. where's the calculation? So another define book value of equity. Financial calculation measures the amount of assets holders own outright and are able to distribute to themselves. Let me go back here. So asset. So we want preferred stocks. Now preferred stocks. How is that showed on a balance sheet? I'm assuming that's just an asset. Let me see here. Okay, preferred stocks on the shareholders' equity statement. Can I see? Okay, here we go. No, that's not a balance sheet. Can I see a balance sheet, please? Here we go. Common stock. Okay. I don't think it's a contra shareholder. Okay, so let's get back in here. So preferred stock and tangible asset. Current assets are included. We'll do a total for long-term assets. Or non-current assets, you call it. Like a building or something, equipment. Non-current asset. What else do we need? Other current asset, not current. Intangible. And this is the one. Now, how did I do it over here? I just did a gray. Yeah, I just did this. Intangible asset not included in, no. Subtracted from assets before dividing by before because we know we want total assets. We want all of this, but we want to subtract this out. So that's why this is highlighted. We also, on the shareholder equity, so shareholders equity, what are you going to have? You know, probably retained earnings. Common stock, prefer. Okay, so we're seeing common stock, preferred stock. And now, we're not going to say book value, we're just going to do total, so shareholders equity. And this has to equal assets have to equal liabilities plus owner's equity. So, and I'm not sourcing this from raw transactions, so I'll just do a filler calculation here. So we can say, you know, so this has to equal this. Minus this, and then minus these. Liabilities and equity, we'll add those up so you can see this equals that, check. That's true. And if I put values here, let's say they had common stock of 15,000 and preferred of 25,000. See, you can see these still say the change of what this value went lower. Now, when we so here's our calculations. We know preferred stock is subtracted out as well. So when we go here, I'm going to say, so debt equity. Long, short term. Long and, so all your loans, long and short term debt divided by book value of shareholders' equity. And what that is so preferred stock is not included because that's something you don't, it's preferred, so it's due to somebody else in most cases. But retained earnings, common stock are things that the company could use to pay off the debt. Let me just reread this real quick. DDE. So debt is calculated by adding outstanding long-term and short-term debt divided by the book value of shareholders' equity. So it's $3 million worth of loans and shareholders' equity of $13 million is worth. Net amount remaining after that. So book value of equity, I'm just making sure I understand the calculation. Book value of equity is we're going to have to go down here. I'm not going to put this check here. Book value of shareholders equity. Book value equity shows. Hold on. So this, also known as shareholders equity, is a firm's common equity that represents the amount available for distribution to shareholders. The book value of equity. So in a company, it's really just all the money that people put in. That's like the value of the common stock, or paid in capital, and return the cumulative retained earnings. So book value. So they're saying book value of equity, also known as shareholders' equity. So they're saying book value of equity and shareholders' equity are the same thing. Hold on, let me look at this again. Because now I'm confused. What if your prospective investment target is borrowing too much? That's a long-term debt divided by the book value of equity. And here we're saying the book value is total assets minus total liabilities. But we're also subtracting out. Let me look at a different calculation here. So determining the book value of a company is more difficult than finding its market value, but it can also be more formal. Many investors, including billionaire Warren Buffett, build fortunes in part by buying stocks with market valuations below their book values. The market value depends on what people are willing to rate. The book value is similar to the firm's net asset value, which jump around much less than stock prices. Learning how to use the book value formula gives investors a more stable path to achieving their financial goals. Book value literally means the value of a business according to its books. So, balance sheet. Theoretically, it is what investors would get if they sold all the company's assets and paid all its debts. Okay, so that's why it doesn't include intangible stuff, because they're trying to get just hard assets and paid off all the debt. And you're not including preferred stuff because that's stuff that the company has to pay out, I'm assuming, if you go to the amount of stockholders. And so you could say it's total assets minus total liabilities. However, million and but this is other thing is saying here, don't include preferred equity and intangible assets. So typically, preferred stock and intangible assets are kind of on the balance sheet, but we don't want them on here. So you can see the pieces that make this up. Book value shows equity is going to be total assets minus intangible assets minus all of the liabilities. Hold on, we didn't actually do, hold on. So, assets, I just have debt here. I want to put all of it. Liabilities. This could be some long term we can put down here. And all these, like, if you're trying to build this from raw transactions, then all the numbers will make sense together. I'm not doing that here. We're just trying to get the high level items so you can see what components make it up. Accounts payable, short-term loans, accounts payable. What else do we put into here? Yeah, accrued expenses. But I think this could be useful if you're trying to understand the financials of a public company. All right, short-term loans, accounts payable, accrued expenses, long-term liability, long-term loans. Other long-term liabilities. It's all of this. And I've just put the filler into retained earnings, which is going to subtract out the rest of these things from assets, subtracting liabilities and assets, so we always balance. So assets, liabilities, equity. Now, we match here. Liabilities and equity equal assets. As you can see here, let me make this. Now, we only want the book value shows equity. We don't want to include intangible assets or preferred stock. And I see why. Because technically this has to be paid out to other people. So the book value shows equity is total assets minus total liabilities minus intangible assets, because we want to reduce assets. Now, for preferred stock, yeah, I believe we subtract this out too. We're not adding back any liabilities. So this is saying right now, if we're to liquidate today, there's $118,000, which means you collect all the money from all your assets that have a fixed cash value. We're not looking at intangibles. You pay off all your loans. You pay off all your accrued liabilities. Long-term loans, you pay all that off. You have retained earnings and common stock. So these are this is like the cumulative of what the company has done over time, which can also be used as turned into cash. We have preferred stock, but that might have to be paid to somebody else, so we're not including that. And these were the main items that not be included as intangible assets and preferred stock. So reduce those off of any money that we could have. We get to 118. Now the ratio is to divide loans, not all liabilities. So loans. So we'll do short-term loans and long-term loans divided by the total amount you've got to pay that off, and there's your debt to equity. 0.1 in this case. Long and short-term debt. So we're looking at this number, and this number. And this number, the book value of equities, is based on all these other inputs. We're subtracting this out, debt portion of ratio, debt portion of ratio. Actually, we'll put that over here. So you feel like analyzing some public companies, look at their balance sheet. You can kind of look at all the different components and try to come up with a debt to equity ratio here. All right, I feel like we did a pretty thorough job there. Return on equity. It's probably a simpler one. That's all balance sheet stuff here. So let's do as many as I can here. So it was 1, 2, 3, 4, 5. This is 6. So just return on equity, I'm assuming, is some amount of earnings divided by equity invested over a period. Let's see what they say. Common shareholders want to know how profitable their capital is in the business they invested in. Return on equity is calculated by taking a firm's net earnings after taxes, subtracting preferred dividends, and dividing the result by common equity dollars in the company. Let's say net earnings are 1.3, preferred dividends are 300,000. Take that and divide it by 8 million in common equity. That gives our ROE total 4%. The higher the ROE, the better the company is at generating profits. It's a good one. Let's let me just undo. All right, let's go back here. Net earnings after tax. Net earnings. So that's definitely an income statement item. Let's say net earnings here in this case is 8 million. I'm just going to format some of this. Give this a bottom border. I think we can no fill this. Just trying to make this formatting a little bit better. These are all assets, not just current. So assets, liabilities, I think I like that without the borders on this. Return, retain earnings, that's fine. Double bottom this. Oh, yeah, that's fine. Alright, so here's the main assets, liabilities, equity. Here's a checker. We'll do a thick bottom on the check. And then book value is subtracts intangible assets and preferred stock before calculating value. So really this could be assets minus liabilities, which is just, again, you could do assets minus liabilities is this number. However, we don't want to include the intangibles, we don't want to include preferred stock. And then we just divide the short and long-term debt by that. There's your ratio. So, pretty simple. Now, where am I kind of got lost. Alright, so that formatting looks a little bit cleaner, I feel. This is the main item. We can make this gray. We're removing these lines. Let's make these actually yellow. Or something. I don't know. Maybe with a lighter gray. Just to show that they're not included down here. Okay, anyway, return equity. So net earnings after tax. What else? Preferred dividends. Less preferred dividends. Value after dividends. Let's just say they're $1 million. So value after for dividends here. We'll do a double bottom. and we want to take that divided by the result. And then we just have common equity. Let's say common equity is $3 million. Essentially, it means, okay, they put $3 million in. This doesn't need decimals. They put $3 million in, and their period earnings less dividends is this. Now, what does that mean? First of all, calculations: common equity divided by net earnings after tax less preferred. Let's say the higher the ROE, the better. So let's see what makes this go up. Let's say net earnings were $50 million. Okay, so we're doing a calculation wrong. What is it? So the correct calculation, I think I got it switched, is yes. So we're dividing we're dividing this number by the capital. So let's say you put $3 million in. It's generating 16 times that for whatever period this is. So that's good. Higher the better. Higher the better. So higher the better on that one. This is lower the better, right? The less debt you have to equity, the better. And we'll do a roll-up. We'll do a summary. Ratio summary. So this is cool. If you're like trying to build a case for a company and you just want to high level see, okay, what's the working capital ratio? What's this? What's the EPS, price to earnings, that's equity, return on equity. You can see, okay, here's how I'm getting all the values, and then here's a summary of the results. Accounting ratio summary. And we're doing more. We're going to do more here, so don't worry. I got 45 minutes at least. And if you like this content, like the video, tell me more stuff you want to see me do. I'll get into the weeds of accounting if you want. I have no problem with that. I've been doing financial model. I did a bunch lately, so I'm kind of trying to do a couple other like more standalone template calculation stuff, calculators. All right, working capital. We can do some cool formatting and visuals on this as well. Or, I mean, you might use this, a company might, if you're like a company that's trying to make metrics on key financial ratios of a company, then you're going to want to know how these are calculated so you can know what formulas to do. Debt to equity. So there's a whole bunch, this has a lot of uses. Return on equity. RDE, ROE. And then how's debt to equity? There's no abbreviation. D to E is fine. D to E, ROE, PE, EPS, quick ratio, that. And then we get our summary, reference the top part of each one. Now you can do all kinds of analysis here. So you've got like you could assign weights to things. You could have a range that you look for. You could have conditional formatting where if a value is above or below a certain value, make it turn colors. All kinds of stuff like that. I don't know if we'll do that here. I'm mainly focused on trying to figure out all the calculations first. Alright, so there's 6 for now. Let's see what else. Well, let's look at some more. Let's go back. Accounting ratios. Okay, we got some people asking questions on a template they bought, and this is use problems. I'm going to tell them to join the stream for Q&A. I'm on here now. So I do, on the live stream, I will do help for people that have questions about templates. Okay. So counting ratios and important subset of financial ratios. I'm just trying to look for some more complex ones than what we've got so far. What's a good one? Sure, we could do some more income statement stuff like gross margin. So we'll pull. These are more for a business's operations, but it's still probably good. So return equity. Like it's good for an analyst as well. Gross margin. Now, gross margin is essentially your revenue minus your variable costs, and then that number divided by your revenue is your gross margin. So we'd have revenue in whatever period it is. This is going to be an income statement. Let's say revenue is, okay, 50 million. Variable costs. So the reason why variable costs you want to isolate, because they change with revenues. For example, if you had, let's say, 5 million in revenue, it's likely that your variable costs are not going to be the same. They're going to be less because they change. These would be things like cost of goods sold is a big one. Like if you sell cars, if you sell 10 cars or 1 million cars, your cost of goods sold is going to be higher if you sold 1 million. It's directly related to the count. So that's a variable cost. You could also have, let's say, every time you sell a car, you have to pay a 2% processing fee to something. Well, that 2% is essentially going to be a direct cost related to revenue. It might not be a cost of goods sold. So variable costs are cost of goods sold as well as other costs directly related to revenues that change with revenue. And they're very important as well because it shows how much of revenue that's being created is actually kept and then can be used to pay off other fixed costs, and then the remaining. So very low gross margins are not good. And every business is different, but if you have very low gross margins, then as you make more money, more revenues, you actually don't make a whole lot more money. So, and this is actually called gross profit or contribution margin. And I always was confused why the actual value here was called contribution margin. Contribution margin, did I spell that right? I like gross profit as the name, and then just I like calling this gross profit margin. Now we just call this a margin. And it's simply, actually we'll put it up here because the rest are up here. It's a percentage, and this time. So it's definitely an important number if you're doing a summary of a company. You want to know the gross margins in general for a given period, probably the last full year. And that's going to be this one. Get that from the income statement. Don't need decimals. Let's see, these decimals, yep, these two, this probably only needs one. Income statement. Yeah. Revenues, variable costs. And that is a ratio. You can consider that a ratio. Total revenues less variable costs divided by total revenues. We already did earnings per share. That's equity we did, quick ratio, we did dividend payout ratio. Okay, dividend payout ratio. What's that about? Cash flow statement provides data for ratios. Cash flow statement provides data for ratios dealing with cash, right? For example, the dividend payout ratio is a percentage of net income paid out to investors through dividends. Both dividends and share repurchases are considered outlays of cash and can be found on the cash flow statement. For example, if dividends are $100,000 and income is $400,000, the dividend payout ratio. Okay, this is a good one. So I know obviously, so I guess we're looking at cash flow statement and income statement. So this is net. You see a lot of stuff's based on net income. So let's say net income is here, let's say 45,000 for the period, whatever it might be. And we're also looking at cash flow statement, because cash flow statement is going to have the dividend payout. And there's nothing really fancy there. Income statement, cash flow statement. Let's say the dividends are $800. Let's say no more than that. 10,000 dividends payouts. ratio is then, what are we doing? Dividend payout ratio. Dividends divided by net income. So in this case, you're paying 22% of the net income out in dividends. So we'll put this in here. I want to put this in with these other ones though. Dividend payout ratio. Oh no. I just essentially removed my entire everything I just did on the gross margin one. Hold on, let's undo all this here. Okay. Copy this, gross margin. Dividend payout. Alright, now we gotta do all that. So this is, make sure I did my description right. Total dividends paid out in period divided by net income in period. Cash flow statement. So net income here again, let's say it's $1 million, whatever period. Dividend payout is, let's say, 250,000. We now see that is 25%. Dividend payout. 1, 2, 3, 4, 5, 6, 7. Ratio number 8 for today. Alright, let's update that. So this is gross margin. I'm going to put this over here. And I'm saying ratio, but honestly, so they're using a percentage. The higher dividend payout ratio is the higher. I guess that's a good one. You can kind of see. So in a real estate investment trust, it'd always be 100% because they're required to pay all their earnings out to the shareholders. That's why you don't see real estate investment trusts growing much, but because they're just giving all their profits to that's just how they work. They give all their profits to the shareholders. And they don't really grow. Period divided. Okay, that was easy. Income statement, item, cash flow statement, item. I'm assuming, let me double check. Dividends paid on cash flow statement. Pretty sure that's where they go. That's where I've always put them. Yep, and that's from financing, dividends paid. I don't think it doesn't belong in operations. I mean, you could a lot of stuff on the cash flow statement operations is pretty clear, but investing versus financing gets tricky. Because you can always justify about anything you can think of. Alright, anyway, what's the next ratio? What's another good one? Oh, here's another one. Berry ratio. Bear ratio is that compares the company's gross profit to its operating expenses. Oh, yeah, that makes sense. So how much is it making, and then of that, how much does it take to keep the lights on? So the ratio is an indicator of a company's profit in a given period. A ratio of, well, yeah, it's company's profit. Yeah, because you subtract OPEX from gross profit, get to net income. So if you divide that expense by the gross profit, it's going to have some relation to your net profit margin as well. A ratio of 1 or more indicates the company's right. So it's above 1, you're making money. If it's not, you're not. So let's do, so we got gross margin already here. Let's copy this one. Berry ratio. I never heard of this actually. Berry. I'm going to put this, yeah, this actually belongs right below here. So we go, what did I say? So gross margin, and then we have another item on the, this is all income statement stuff. Operating expenses. Let's say the operating expenses here are 25 million. And it's going to be, every company is different. So we take gross profit divided by expenses, and that's going to be a numbered ratio. Oh, we need 1. So let's say so numbers below 1 are bad. So what did I say? Higher, better. Gross margin, obviously higher, better. Higher is better. Higher is better. Higher is better. Dividend payout. I guess this doesn't, I mean, it depends. It's not empirically better or worse for that dividend payout ratio. This higher is better for sure. If my OPEX is only like 10 million or a million, it's 10 million, 4.9. It's higher and that's better. Berry. Total, so this is gross profit divided by operating expenses. Alright, well, there's not much more you could say about that. Higher is better, lower is better on this one. I'm just changing the to is, lower is better. Price to earnings is subjective. I mean, earnings per share, higher is better. Quick ratio. Higher is better. Right, because if this is like 100 million, yeah, that means you've got more assets compared to liabilities. And higher is better here. And then let's do, I'm going to pull in the definition for all these in the summary as well. And we're going to use indirect function, which, let me make sure I remember. Indirect with a reference. I gotta get it. Excel indirect with cell reference. It's been a while. The indirect function is great for certain things for sure, though. It's really good. But I just don't use it all the time. Alright, where's the example? It's a good one. Here we go. I believe this is it. And then the sheet name is going to be this. And then I want to see what cell. D3 on all these. Oh, this stupid thing. Oh, come on. Indirect with the reference. Where is it? Bear with me, bear with me. Here we go. What did I say, A4 or something? And my reference is here. D3. Or no, I don't want D3, I want C4, the description. So now I can just drag this down and there you go. Oh, shoot. What? Oh, I gotta actually name these the same as the tab name. Alright, so we're missing, so price to earnings. Equity. Dividend payout. Okay, description. So we got the ratio name, value, and description. Perfect. Cool. Okay, berry ratio. What else do we got here? We did debt to equity, quick, current, gross margin. Okay, they didn't have any extra ones. Profit margin. I mean, I guess we can add profit margin. So gross margin and then profit margin. Put that after gross. What's my order here? Hold on. Dividend payout is ahead of Barry. I want these to follow the same order. So working capital, quick ratio, earnings per share, price to earnings, debt to equity, return on equity, gross margin. Okay, then profit margins next. Dividend payout. Okay. Now profit margin is just taking into account fixed expenses, and then like fixed costs. You may also have taxes in here, everything that goes into net income. So revenue minus this, and then the ratio is just total here divided by revenue. You know, let's make this reasonable. Let's say revenues are 3 million. This is 2 million. Oh. Do a decimal on that. So total revenue less variable costs less. Oh shoot. Less. What do we want to say? Less all expenses. Fixed, variable, otherwise taxes divided by total revenues. Higher is better. 1, 2, 3, 4, 5, 6, 7, 8. So this is 8. We'll do 9 and then 10. It's good. Dividend pay. Higher is better. Higher better. D3. And if you work in this every day, these are pretty obvious. Well, most of these numbers are probably obvious. But if you're seeing this for the first time, it's definitely not. And this is a great resource to see the calculations. Oh, shoot. Okay, sorry. Just saw you there. Hey, just saw. Welcome, Enov 8 Labs. Yeah, so this video I'm doing now, I will post. I mean, it's going to be on YouTube for free. You can see it. Are you the one with the SAS model question? About the date? Okay, perfect. So let me look at what you did here. Have you updated the date on the monthly to that year? It should be 1/1/2022, and then you should be able to pick it from the drop down. I think the monthly detail tab. Let me just look at it on my end real quick too to make sure I'm telling you the right thing. So this is a standard SAS model. Let's see. Where is it? So you should be on the 5-year monthly P&L, cell C1, just enter the first day of that year, so 1/1/2022. 1/1/2022. And then you go over to user assumptions, and the drop down should update to those dates. Cell C1 on the 5-year monthly P&L detail. Let me know if you have any, just let me know if that worked or not. Alright, what other ratios am I doing here? Oh, let's number these actually. Number. For reference. No. So did you change the date on the monthly P&L to in cell C1? No. I don't think I could. Let me see if I could change my display capture here. Window capture. We'll just pull it up here. Hold on. Okay. Can you see my screen? This should be the model you're talking about, I'm assuming. And up here it should be for your situation 1/1/2022. And then if you go back to user assumptions, now you can see the date you can select is starting in 2022. Okay, on the 5-year monthly P&L, see that in cell C1? 5-year monthly P&L tab. And you should change that to your 1/1/2022 so that the model will start in your 2022 instead of 2021. And then when you do that, the drop downs will update on the user assumptions tab automatically, so you can select your month in November. I think that's the problem you're having. The value under is not valid. Oh wait. Well, the start month is already before 2022, so user restricted value. What did you actually enter into the user assumptions drop down? Did you just select November 2022? Because that should be in there. Like the base model that I sent starts in 1/1/2021. But if your start month is November of 2022, you could just use the scroll button to select November 2022. Now, if that is the very start year, you're also going to want to update the year on the monthly P&L it's driven from here, which should change the start month or start year if nothing's going on in 2021. The 5-year monthly? Are you sure? The 5-year monthly P&L detail. It should be in cell C1. And that's been there, I think this model is one of the, that's definitely been there forever. Okay, hold on. I'm going to email you the file I'm literally looking at. Figure this out. Let's see. Oh shoot, I can't log into this here. Alright. I'll send it on my phone. Okay. Now, I just sent you a file, which is the most recent file. And you want to change the start year, go to the 5-year monthly P&L detail and change the start year that's in cell C1. To 2022. And then you should just be able to select that year or that month in the drop downs. And I'm going to switch this back over to this one. Yep, just let me know if you had any issues. Alright, so Berry ratio. Do I want to do another profit margin, quick, current? Current's kind of like the working capital, so I'm not going to add that one. Debt to equity, return on investment. We could do return on investment. Might as well put it in here. Return on investment. So this is different than an equity multiple. And we're just looking at initial investment, and the only difference is equity multiple. It has a 1 on it, and ROI is just the actual amount after removing the initial investment repayment. So initial investment, let's say it's $10,000. Total returned, let's say it's 20,000. No, let's say 12,000. Now your ROI would simply be returned minus investment divided by investment. And source of that is not any statement, that's more of a, that's not a operating ratio, but total investment less total return cash less initial investment divided by initial investment. And equity multiple in this case would just be 1.2 or 20% that number minus 1. Higher is better. Okay. On 2.1, oh yeah, that's probably over a year old. That's the older version. So, but it should have still had the right date. But anyway, yeah. Hold on, let me pull up the screen here. Yeah, 2.4 is the most recent. Okay, let me get back here. Where is it? All right, let me switch sources. Alrighty. There we are. So you can see in cell C1, all you would need to do is change the 2021 to a 2022 if that's your start year. And then go to user assumptions and select, you said November 2022 is your start month, so you just go into there, pick November 2022. And you can adjust the other tiers accordingly if they're applicable. If not, you can zero them out. What? Row 2 is double wide. What? Did you download it to Excel? Row 2 is double wide. Right, but that shouldn't matter. You should be able to go in here to cell C4 and select your month from the drop down. On your 5-year P&L, your row 2 is double wide. On the 5-year monthly, what do you mean double wide? Oh dear. Yes, what? What? You should only be in row 1 to change the date. Right here in cell C1. And literally click it and hit 2022, make the year 2022 instead of 2021. Yeah, we may need to screen share because I am beyond confused. We've sold over, I don't even know what, 150 of these, and I don't know what you are talking about. Let me get back. I'm sure it's just something with, I mean, maybe the Excel version. One, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Return on investment. Yeah, I thought you were on the wrong tab because that I was really confused. What you were talking about? Yeah, on that one so that template's I think my first template I ever built, and I put the annual tab in front of the monthly, so it's a little bit not intuitive, I guess. But yeah, the month. That's why I kept saying the monthly tab is where you change the date. On my newer templates, if you've seen the newer ones, I think you did. I'm not sure, but you can see the date, all those assumptions are on their own tab at the front of the whole model. But that one is just like it is because it's original. That's the original style I used to do. All right, do I have? Ooh, accounts receivable turnover. Man, there's a lot more. All right, I'm gonna probably end the stream here, guys. We helped out our customer here, and then we got 11 ratios. I'm gonna add a bunch more next week because there's more. There's a lot more I can do here. So take it easy. I'm glad you got it there. Innovate Labs. You take it easy, and I will see you guys next week. We'll do more accounting ratios then.